आपको बना दिया मैंने होस्ट।
एजेंडा चेक कर। ठीक है। सबमिट कर।
कोई दिक्कत हो तो बताइएगा।
गवर्नमेंट में सेंट्रल में नहीं लगता है सबको टैक्स तो उनका कोई होता नहीं है वो बोलते थोड़ी है उस तरह से आती नहीं है हाँ सवाल सीधा आप गए तो बोले कुछ ठीक
हाँ जी, गुड आफ्टरनून डॉक्टर आसिमा जी।
Good afternoon, Shri Agarwal. So, hi Abhik,
Hi, hi.
how are you?
Very well. How are you?
All well. So, a lot of fireworks this week.
Yes, especially last last evening. So
Mm,
things have been looking very uncertain.
right.
But good news after a long time.
Very
Yes.
good news.
So, industry must be really pleased, Agarwal ji.
क्या से अगेन क्या कह रहे हैं?
तो आपके सब your members must be very pleased, industry
Yeah,
वाले.
everyone is very happy. Investors, members, everyone, exporters. You see, it was expected. कब होगा? मैं एवरी टाइम इवन राजेश अग्रवाल कॉमर्स सेक्रेटरी ही इज टेलिंग दैट कि भी वेरी सून इट इज गोइंग टू हैपन. इवन पीयूष गोयल जी एंड गवर्नमेंट डिपार्टमेंट एवरीवन वाज टेलिंग कि भाई soon it will happen, soon it will happen, but now it has happened. Really, it is
Yeah,
fantastic.
people were doubtful also because first it had been promised for so
Still
long since
still the
November.
credibility of Trump, you are not sure that he once again he can say you have not stopped importing oil from
Hmm.
Russia again. मतलब 99% is okay, but still 1% the credibility of Trump is very difficult.
No, but I think India's built its own credibility, in the sense we have the other alternate FTAs and, we're building alternatives,
Yeah,
diversity. So that
yeah.
is,
India European Union agreement has been
so
free trade
people should
agreement
be
has
more
been there.
confident in, so industry must be more confident in India than in Trump, right?
Yes, we actually US need more this treaty. It is in the benefit of US more than India, but still mutually, if you see, it is beneficial for everyone. And
Right, right, right.
yeah,
Yeah, I think America woke up after the FTA with the Europe. They started
yes,
feeling they're getting left behind. So, the strategy of diversifying really helped, I think.
correct. So I think it's already 3.
Yeah,
So
Charan is not there.
Dr. Charan is not here. Yes, he is not here. Let us wait for him.
How come we are doing this on Zoom? Normally we do use WebEx, isn't it?
Dr. Charan Singh has joined.
Mm.
Good afternoon,
Charan,
Dr. Charan Singh.
where are you? I still can't see you. Actually, we are using this WebEx. There you are.
Okay.
That's Naren. Everybody's here, so we can start. Agarwal ji, you will start.
Should I start? Yeah,
Yes,
thank
please.
you. Thank you, everyone. Thank you, ASSOCHAM. Thank you, EGROW Foundation, for timely organizing this Shadow Monetary Policy Committee meeting discussion on RBI policy. It's a great opportunity for me to welcome address. So I would like to thank Dr. Asima Goyal, who is chairing the session, and she is the former member, Monetary Policy Committee, RBI, and Professor IGIDR. Every time Dr. Charan Singh is supporting SOCHAM, attending 100% attendance. He is Chief Executive EGROW Foundation and always giving very good input in RBI monetary policy. So we welcome him. In the same way, many panelists are there. Ms. Swati Saxena, Mr. Sujit Kumar, Abhik Barua, Ms. Upasana Bhardwaj, Mr. Siddharth Sanyal, Mr. Arun G. Nagarajan, and Mr. Ankit Raghav. So all are good panelists, very good. Their insight is very, very great. They are good economists, and we welcome you all for attending this conference of Shadow Monetary Policy Committee meeting. So thank you once again for everything. Yeah, on 6th February, RBI is to declare the monetary policy. I think this is happening after budget and two more trade agreements with the European Union as well as with US. Most awaited. We once, when we had agreement with European Union, we said it's a mother of all deals, all agreements. But US agreement, you can say it is mother and father of all trade deals. So it is very urgently required because the kind of trade surplus which India was having with US, that is around 40 billion US dollar to 45 billion dollar. And the export which we used to do, labor intensive, footwear, gem and jewelry, and leather items, uh, and ship items, sea items, seafood items, shrimps and also. So that quality of export we have is very useful. So we everyone is happy after having this trade deal with US. In the same way, we have very good deal with European Union also, where the trade was around 145 billion US dollar, and there also India was having surplus, trade surplus around 10 billion US dollar. So both trade deals are very, very good in point of India. So while and even budget, if you see, it's a very growth oriented budget, and uh, recently, and the modern technology needed, AI, digital, uh, uh, semiconductor, these type of manufacturing processing we want to establish in India, and and finance minister has given full support in this budget uh, by providing tax holiday up to 2047. Those who will invest in India by foreign investor. Already we have tied up 70 billion US dollar by Amazon, Microsoft, and Google. And I think, as per the statement of Dr. Aswani Vaishnav, that 200 billion US dollar can come in form of FDI in this sector. So it's a greatly needed, and even more, she has extended tax holiday for 20 years in Gift City, IFSC. So these are good developments which has happened recently. In 10 days time, European Union deal, this budget, and US trade deal. So so RBI basically decide their rates on the basis of our foreign exchange, currency, uh, economic development and global developments. So inflation is already on controlled basis 2.1, and even in economic survey and budget is expecting to remain with 4%, and growth is also very good, 7.4% throughout the year for 25-26, and expected to in 26-27 should be 6.8%, which is also very good. And fiscal deficit is under control, 4.4% this year and 4.3% making in the 26-27. So considering everything, uh, finance minister is also having trust in declaring their fiscal deficit as well as growth. She is not declaring any populistic budget, so she remain trustworthy, following a road path of fiscal deficit. So considering all these, stable growth, controlled inflation, global cues are okay. I think RBI will not decrease further. It should remain at 5.25%. And already in the last year, 125 basis point, RBI governor has already reduced it. So there is no point to reduce now. And I think everything in the economy, growth is good. And considering this, I think no reduction should be needed. Thank you very much. I conclude once again. Thanks all the panelists and Dr. Asima Goel, Dr. Charan Singh, and all the viewers. And thank you organizing for organizing monetary policy meeting by ASSOCHAM and the EGROW Foundation, and giving me the opportunity to deliver the welcome address. Thank you very much once again. Dhanyavad.
Thank you, Agarwalji, for taking us through all the fireworks we've seen in the last week. And I think
Thank you.
let us sort of go to the sort of core determinants of the MPC decision. So, although in December core inflation rose somewhat, people were saying inflation has risen, but what had it risen to? 1.3% from headline inflation. CPI core was 4.6%, but CPI core ex gold was below 3. The RBI in the December policy expected inflation to be around 3% in first quarter, and market expectations are largely the same, and to reach 4% in April. Also, the new CPI series is to be released in mid-February, and this will raise inflation slightly because it will give the weight on food, which is low, will fall, where inflation is low, will fall. Growth is above 7%, and the trade deals will give a further fillip to growth. So a pause is called for now. I agree with Agarwalji. The situation is too volatile and should settle by the next MPC meeting when a further decision can be taken in just a couple of months. The forward-looking and growth-supporting budget continues on the consolidation path, but since gross market borrowing exceeded market expectations, the 10-year G-Sec yield rose after the budget, reaching 6.77 on yesterday. Yields have risen after falling below 6.5 after the December MPC meeting and rate cut, because of liquidity tightening with outflows and large state borrowing. So this time, policy must focus on injecting adequate liquidity, sterilizing the effect of outflows, although it will have to be sort of, kind of looking at current situation, because reversal of outflows is likely after the US trade deal. But the most important feature which I would like to discuss with the market participants who are part of this Shadow Monetary Policy Committee is that communication and tone because I believe these will play a major role in the further transmission of rate cuts. The tone must be dovish, indicating adequate liquidity support and that there is still space available for further data-dependent cuts. Improving food supply chains, green alternatives to fuel, oil, and lower weight of commodities may imply long-term relief from commodity price spikes. The neutral stance should be retained. Some research suggests that GSEC yields are sensitive to relative demand and supply, as well as seem to be reluctant to give up a floor price for India. Spreads tend to rise while long rates do not fall as much as short rates when repo rates fall. But as risks and price shocks reduce, that floor has to fall. And appropriate communication can play a major role in persuading markets that this is so. So I look forward to discussion on especially this issue and of course the member views on the rate cut and the stance. So Dr. Charan Singh, would you like to give your views?
Professor, thank you very much for this overview. And you've given us the picture of the economy. And actually, in the last 5 days since the economic survey, all of us have been seeped into the picture of the Indian economy, right? And you have given us, in nutshell, the cream of it and what is going to matter to us. My reaction, my two bits, and I'll be very brief on this, is we are at a cusp of a very golden period. While the Indo-EU agreement is going to take a year to be signed, ratified, and get implemented, but the positive signs are very clear for us. We are all in that state of exuberance. And less than 12 hours ago, we got a further boost with the understanding that there could be an Indo-US deal too. So right now, we are in a very exuberant state. We are just thrilled, and probably we are not very sure of the good times that we are going to face in days to come, right? So to that extent, I agree with you that we are in the happy, uncertain phase. It's going to be good, but how good will be good, we are not very sure. As far as the Indian economy is concerned, the statistics has been everywhere, right from what the chief economic advisor had to say. I would only pick up one of it, and that is we are in a very happy state of non-performing assets. It's so low that even I've been a banker for many years, even I can't believe. I'm so excited and thrilled that Indian economy could be doing so well. Part of the credit goes to the bankers who have insured, and part of the credit goes to the economy, which is booming because it's profitable and the economy is doing well. People are able to repay their loans. This is the scene in which we are. We are going to have a review of the major review of the monetary policy. The annual policy is just about 2 months away. So in April, we are going to get it. You know it, I know it. Many of us are aware that we have a governor who is very friendly to NBFCs. Just 2 days back, the finance minister wants to set up a committee which will be a follow-up to my mind, like the Narsimham Committee on Banking. Right? So the banking sector's role in the next 22 years is going to emerge very clearly. Can there be a better time than this to cut the rate? So I would urge the governor and the MPC that, look, we all know our inflation, you have given the figures. Our inflation is the lowest, much lower than comfort level, to be honest with you. But it is lowest. It's not expected to go up. But if we are to rise to the Indo-EU, Indo-US agreements, we need to push up our manufacturing. We need to give a fillip to our industry, to MSMEs, to the housing sector. All these need a rebate on the interest rate. our interest rate reduction has been constipated sufficiently. I would say there was a ratchet effect towards the lower end. At this point of time, I think it is high time a 25 basis cut would be very accommodative and justified. Given the global scenario, given our interest rate scenario in the country, that would also strengthen the sentiment of the budget. The sentiment of the budget, as I have been saying in various interviews, we have 22 years to go for our main Viksit Bharat state. For those 22 years, the first step has been climbed. 21 more such budgets will come. In these 22 steps, we have to now make our per capita income go up between 6 and 7 times. I think it's a good starting point that given everything that you have narrated, the chief economic advisor narrated, the beautiful economy that we see it in front of us, just imagine our growth projections have been raised. And last point I want to make, Professor, is while all the projections that you have seen amidst exuberance are in the range of 7.2%. The economy has responded so beautifully to every time the government put their foot on the accelerator. Mild correction, mild reform, GST, economy is responding. Labor laws, economy is responding. But we know 7.2% is not going to make us Viksit. We need at least 8.5. What can we do to further that growth given the scenario that you have? To my mind, is interest rate reduction, 25 basis point. If you want to set up 5 model cities which will line up with the industry and become Silicon Valleys, something like Silicon Valleys, that 5 cities have to develop on the basis of loans. So my recommendation would be, and I'm with you as far as the stance is concerned, I'm totally with you as far as liquidity is concerned. But I think interest rate reduction, that can't be a better time than this. I also want to add, Professor, one more thing, that towards Viksit Bharat, maybe from April it'll start, but we will have to think, should we have the priority sector the way they are? Should we have the SLRs the way they are? Period of time. Now it's time to make our banking system supervision and regulation and these sort of stipulated um, conditions on the bank assets, on the bank volumes, that we need to start thinking in terms of diluting CRR, SRR, SLR, priority sector lending. But probably that can wait till April. This time, we should set the tone, match the budget exuberant and the environment in the country by at least a 25 basis rate cut. Thank you for your time.
Thank you, Charan. So, the issue we saw after the December rate cut was that it didn't get passed through because GSEC yields rose and banks compete with GSEC. So loan rates also did not fall much. So I think this is a time to sort of set all that transmission right with appropriate concern, communication, etc. And then in April, take a call when you'll have the new series, you know what inflation is looking like. And some of the volatility with all the very rapid recent developments will have settled. As you're saying, it's an annual monetary policy period. But I agree there is a issue to debate here, and let us see what our other participants feel on this issue. Ms. Swati Saxena is there. I'll follow the order in this brochure.
Ma'am, she is not here. Chagra over here.
Not here? Okay, then
She will be
Abhi,
sharing her inputs, I guess.
she joined later. Yeah, whenever she joins, we'll call.
Okay, ma'am.
Abhi?
Thanks, Ashima. I think this is a period, a day of extreme uncertainty. And while there is cause for cheer and exuberance, let me flag some questions that I have about the trade deal. I'm not too sure of what will happen. Certainly, I mean, the markets have gone up and so forth. But one of the big problems have been portfolio inflows. And the portfolio outflows had started well before we had this punitive tariff. So I would like to wait and see how FPIs respond to this, whether their apparent bearishness on India was really playing on the tariff situation, or whether there are more sort of fundamental issues. I think the budget was a bit of a disappointment in terms of giving long-term direction, which people perhaps wanted. And I think the flavor of the month is really innovation, AI, and tech. And I think India has fallen behind little. So unless that cycle turns, whether we will get what kind of flows we will get, I think we also need clarity on whether we have committed to making investments in the US. And I'd just like to take the case of South Korea, where initially, after their tariffs were reduced, the Korean won saw significant appreciation. But once their commitments to investing in the US were made clear, you've seen a depreciation there. On the on the trade deals, let me just sort of incidentally completely agree with you on the stance, on the need for communication, on the need to bring the floor rate for the GSEC yields down. And instead of cutting the rate, I think better communication to ensure that that sort of happens is important. But I just have a couple of problems with the EU tariff deal. Actually, one problem. I think the EU is notorious for imposing non-tariff barriers, all kinds of, phytosanitary things. So you also have the CBAM. So how much we gain there is really an issue. As far as the US is concerned, we need to see how much we've given away, which are the sectors that are vulnerable in India, because it's not a one-way street. We are also giving, I think, significant market access, much more than we had planned to do earlier. So I think there are a lot of moving parts. And I think the optimal response to a situation like this is to kind of stay put, ensure that your whatever you've tried to do in the past is actually manifested in a market movement, specifically a downshift in the flow rate and overall bond deals and borrowing in general. I think with the kind of paper supply that is coming in, particularly likely from the States, uh, ceteris paribus, we need to sort of ensure that there is enough money in the system so that things don't get pushed up, the yields don't get pushed up too much. I personally think that there is a bit of a risk for growth going forward. I'm a little concerned about this transition from Manrega to VPG Ramji. The allocations the allocations are large, significantly higher than the allocation to Manrega last year. But remember that we sort of committed to 120 days of employment guarantee. The states have to play a role, etc. So it's a bit of a mess out there, and we need to see how smooth and how seamless this transition is. Otherwise, we might have a short-term consumption problem. But all in all, I think I'm sort of completely on the same page as Ashima, that I think we need to perhaps hold our horses this time, wait and watch a little, and focus more on transmission, along with ensuring that there is adequate liquidity in the system to absorb the supply of bonds. That being said, I kind of, I think Charan has kind of laid the foundations for a broader debate. When in the 90s we used to talk about sort of the development role of a central bank and how it can play a part in sort of ensuring a trajectory for long-term growth. And I think there is some research, including by Philippe Aghion, that you need to have much more credit than your short-term macro assessment would warrant. I think that is a debate that we need to get into, and sort of whether we should partly shift away from the obsession with short-term macro management through monetary policy, which is sort of the dominant paradigm influenced by the developed economies, and think of what kind of credit and money supply and rates are compatible with a long-term growth path for a low middle income economy. That's it from me. Thank you.
Thank you, Abhik. Excellent points. And I just want to take you up a little bit on this AI question. That FPIs and the importance of AIs, and that India has fallen behind. So I think that whether that is the main reason for outflows or the tariff and everything added on to it, but I think this budget, for example, lays out a lot of initiatives for AI. And there is a view that AI can really help India in developing skilling for the low level as well as innovation at the high end. And, like I've heard Nandan talk about this, that with our India stack, and you can develop use cases which really improve productivity. And I think when markets focus on the broad, innovations, the large models and research and money going into that, they are missing all these aspects which are more relevant for India and which can really raise productivity and so on. So
Yes, Ashima,
again,
I agree
maybe
with.
some communication is required on this.
No, Ashima, but there, I want to make a point here. I think we are very good at adoption. We are, if you look at the IMF's AI adoption index, we score very high, much better than the other emerging markets. But I'm talking more about AI. So the beneficiaries of this, ultimately, in terms of the supply of AI tools, are the American companies or the Chinese companies or whatever. For India, which has been considered a bit of a tech giant, I mean, it's ironic to see that we are nowhere close to any kind of niche product in the AI tech space. And I just sort of drawn, one of my students at Ashoka, who was a computer science major, did an excellent paper called Where's India's Next Large Language Model? And she just went through the entire, so what is needed and what kind of investments, what kind of incentives are needed to generate AI creation. And she says her conclusion, and it's based on a lot of papers, we are sort of woefully behind on that. So I think the line between adoption and generation needs to be maintained.
Right, but generation also involves more risks. People see the US is vulnerable if it does not win the race in generative AI, and so much money going into, no diversification. So there's
Yeah,
no,
risk.
I mean, India does not need to get into that race. It would waste resources tremendously. We need to.
Well, I don't know. I mean, it's an open question.
But
We
of
can
course,
debate this.
Yeah, but of course, the technology and the importance of manufacturing, the budget has a lot to incentivize high-tech manufacturing and data centers, etc. So, we're not totally neglecting that manufacturing aspect. And I
We might have
absolutely
a
agree with your
tax on
point.
data centers. Peter Navarro has been talking about tax. So I'm just a little worried that, Navarro gets trumps here on this. So anyway, I'm sorry, I'm just being
Yeah,
frivolous.
I think the issue is that markets have been too concerned about AI and too focused on the US. And I think that this whole episode will help India long term, whether we get all the benefits expected from the tariff, from the trade deals or not. It will help us because it's forced us to diversify and hedge our bets and develop other kind of sources, which makes our growth more robust. And I absolutely agree with your point that potential growth and what the CBI can do for this, what the central bank can do for this. And my own view is, and I used to say this in the MPC also, is that while reforms raise potential growth, the central bank has to really respond to the ground and make sure that actual growth rises to that potential.
True, very true. Yeah,
Keep real rates in the neutral or growth stimulating range and so on.
absolutely.
So that is why I agree with Charan that you need low rates for growth. But first, the system should be such that those rates are passed through. In the next 2 months, I think we need to work towards that.
Right.
So thank you. Very, very interesting
Thanks.
points. And Upasna, we're looking forward to your views on this.
Sure. Thank you. Yeah, so I think, again, at the broader level, I am expecting a pause, and I don't think there's need for one right now. I agree that there is a lot of volatility. And at the most important part is, even if they do deliver a rate cut, it's going to be a completely wasted ammunition at this point in time. It is more important to focus more on liquidity, providing adequate liquidity, because while RBI is providing for, I mean, if we look at the kind of extent of liquidity measures that they've done, it's again unprecedented in a normal environment. But there is clearly a need for it. I mean, if you look at the kind of disruption that has happened since, actually this problem has all continued since July onwards largely, or maybe it has its genesis from the June policy itself. But from there, we've not really seen a comeback despite such kind of aggressive liquidity measures by RBI. So I think clearly that aspect, that gap which is there, has to be addressed by RBI. Whether it requires addressing it through normal liquidity channels, that is going to be there. But I think there are also other issues at the back end, which the banks are facing issues, because of which actually the interest rates are going higher. Now I'll just give an example. For example, from 1st of April onwards, the benefit on LCR which was provided for the banks. Now that is something which will create decent cushion for the banks, and they don't need to buy. At this point, what's happening is, in the bond market, it is not the problem of supply. Supply issue has come up from Sunday, because of next year's supply being higher. But prior to that, also, if we look at for this year itself, it is the supply of $20 trillion rupees that we were talking about has remained the same from February last year. It is the lack of demand which has actually caused the yield curve to go higher. Now that demand, we haven't had adequate insurance related flows. The NPS guidelines which had changed to ensure that there is reallocation of funds towards equity portfolio as well. That too, it's normalized now, that NPS related regulation, but that did have a bearing on demand for this year. And the third very important one is, of course, the banks not buying. Now, what has happened is, banks had lapped up enough bonds in the past. They were sitting with 29% of SLR ratio. Slowly and slowly, if you see today, we are slightly below 26%. And as we go into the next year, 1st of April onwards, they don't need to maintain as much SLR, LCR, and hence, SLR. So what will happen is, the the bond demand, which was largely wherein banks were a big component or a big buyer, they are going to be less and less buying it. So there will be pressure on the demand supply side. Having said that, if you look at next year's liquidity requirement, just purely, even if I assume that flows are going to stabilize now that the US-India trade deal is nearing its, until it doesn't get signed off, let's not say anything, because, Trump being Trump, we don't know how this really works out. But yeah, at the moment, at least, it's looking good. And I would agree with Abhik actually here. There are 3 things. One is the investor confidence, which was being eroded because of the US-India trade deal delays. The other is, there was discussion about AI, but I think it is a reality that last year funds have gone largely to the countries which have had decent contribution for related to AI. So, talking from a foreign investor perspective, the theme has been AI or tech led. And as a result of which, because India has been lagging behind, there have been outflows also related to that. So now that we have the US-India trade deal done with, probably this is one good factor which will be positive flows. But maybe we'll have to be watchful on whether we really see a turnaround immediately, or it takes a while before we settle on flows. I think FPI flows are going to be playing an important role, especially because while FDI gross numbers are looking good compared to last year, April to November, I think inflows on FDI was about 17 billion. Today it's 27 billion this period. So it's pretty good, 10 billion more. But having said that, we do have a net number which is very weak still. So FDI is not good, and at the same time, FPI is not picking up. So there will be pressure on BOP till we don't see stability in FPI. And I think even FDI related flows should improve over a period of time. Some of the small bits that have been announced in the budget also, I think, could be a source for that, the focus, but it doesn't turn around immediately. So we have to keep that in mind. I think that's the reason RBI should maintain only largely focused on how to ensure that there is no liquidity crunch in the system. And they should be focusing on that to ensure that the transmission is not hindered. And as a result of which the guidance is equally important. So as Professor Goel said, I think by any chance they were to try to sound neutral to even marginally hawkish, it's going to be disastrous for the moment. So it is better to sound marginally dovish rather than neutral to hawkish. That's how I would say this. So from a growth perspective, again, I do remain a little, I'm not sure whether the 7% next year can be achieved. We are at the moment looking at 6.5%. But of course, I guess by the time we meet next, we will have the new GDP series and we'll be in a better position to comment on the actual numbers. So CPI and GDP series once we have. But I think overall inflation is not a problem going ahead next year. Of course, food inflation can be volatile, but given the weightages are lower this year, based on the new weights, the FY26 trajectory is looking about 30 to 50 basis higher. We don't know exactly the extent. So, like we were at 2.1%, which is looking closer to 2.5% currently. And if that happens, everything else remaining the same, obviously it's a very benign assumption, but next year should be marginally lower, if anything. But of course, we have to wait for all the details on the CPI series to have a much more coherent view on that. So CPI, otherwise, broadly, don't look at too much of a problem on inflation. Growth could be muted. If the economic survey says 7% is potential growth, then I think we'll be lower than potential growth. So we might see some room for action later. But this is not the right time because there's too much volatility and it is going to be a wasted tool. So I would advise a pause in this policy.
Right. Thank you, Pasna. So, this issue of banks and because I was hearing an opposite argument about SLR, that since banks need to hold, they don't have treasuries to sell to necessarily. They don't have GSECs to sell, and therefore CRR cut would be better. I don't know.
CRR cut is a different tool, ma'am. Yes, I agree. See, right now what's happened is, in fact, this is one of the advices which we have suggested. See, banks are holding in terms of liquid funds. They have a LCR now, which was not the case 5-6 years ago. So why not relook at the way a bank it has adequate liquid funds or not? So we should be, over a period of time, reduction in CRR is not a bad idea. So I guess, we've already
No,
seen.
because the RBI is restricted to the secondary market, for OMO. So if people don't sell them GSECs, if banks want to hold on to GSECs, there's that limit
In
on
the
how
secondary,
much
yes. In the primary, they're doing,
the
they have to
secondary
move to
market,
liquid.
right? But, I think they're there. So how do they design OMOs?
No, OMO purchases in primary they are doing, and there also there are times they choose securities which are highly illiquid. It is a recent OMO which had some liquid securities. So I think they'll have to look at that as well and focus more on the liquid side so that the market has the ability to churn that better. I think that is also important to keep in mind.
Yeah, but actually, because this problem has arisen through sterilization, large outflows, the absence of not full sterilization. Otherwise, as you were saying, they have injected huge amounts of liquidity, but it's proved inadequate. So they
And also,
need
ma'am,
to.
what happens is there's a lead lag, right? So while there could be times, for example, much of January saw tightness in liquidity, system liquidity.
Right,
Yeah, it's also about that, right? We might have a durable liquidity which is at 4 lakh crore. But if the system for a long time doesn't have that money coming back into the system, then the system liquidity comes under stress. And the moment that happens, it spills over into the rest of the market.
So let me just put the question more precisely. Is the market confident, since its governor has been communicating and the RBI has repeatedly been injecting liquidity, is the market now confident that the RBI is committed, this regime is committed to maintaining liquidity and surplus? And do they feel that the tools to do this are adequate, or is there a worry about either the first or the second?
Okay, the way I understand from our back end, the people who are into operations, I would say, um, confidence, because the governor is actually going everywhere and saying this. So I
Yes.
keep arguing the same at my back end. Why are we questioning that? We should not be questioning that, Under all circumstances, RBI is there to provide. Till we don't see a shift in their stance because inflation is higher or whatever it is. So the problem that comes for them is not necessarily the kind of liquidity which was coming until now. See, if you see the SDF, for example, a lot of time it's mentioned that at SDF about on an average 1 lakh crore is maintained, and yet we are seeing liquidity tightness and other issues. But these are operational aspects, wherein the banks, because of 24x7 operations that have now started, which was not the case earlier, these are issues which need to be kept in mind that about 0.4 to 0.5% of NDTL will be maintained by the banking system overnight, come what may. So there are certain aspects which have to be kept in mind, and hence when we talk about durable liquidity, we should probably net out that 0.5% because that is something which banks can't do much about. They will maintain it. So like that, there are several other aspects. Actually, there are a lot of technical issues as well, because of which, while the confidence on what he's saying is there, uh, whether that really translates into adequate funding. For example, CD rates, if we look at, normally what happens is in the month of March, the certificate of deposit rates, a little maybe February, March, we tend to see them spike because of the year-end phenomena. This time since December, we have seen a significant spike in CD rates. Now, there are other aspects as well. Mutual funds, there's no flow in that, so there's no demand for it. Of course, we've seen some correction in the 1 year CD and all from the highs, but I'm just trying to say, after this very recent 90-day VRRs that RBI provided with a prepayment option, I think that's again a very good move, telling the market that I'm ready to explore newer instruments. It is not just VRR, but the prepayment option. Prepayment option is a very good way. But we've seen the market rates, overnight rates have crashed actually in the last 3 days or so. So we have seen that happen, but consistently, otherwise, WACR was higher at 540, 45 or so. Now we've seen since the 91-day happened. So I think 90 days, sorry, VRR happened. So these are things which are happening. I think RBI is also taking adequate feedback from the market to see how they can, even out some of the frictions which are existing, which is beyond the surface,
Yeah. Now, that is precisely because they're open and they're talking to the market, and your back-end people must be giving them feedback, this, and, so, and they react. Because I think the only issue is sometimes bureaucrats tend to feel that the market is, that lazy banking issue, that they could be doing more themselves. They want crutches.
Mama, I think that lazy banking thing is no more applicable. I would not agree. Now, at this point, I think bankers are all on the edge right now. They have a tough time on liquidity management. So it is, I don't think that lazy banking is anymore.
Yeah, so the issue is that you must have, if your backend people, whoever talks to the RBI, have clear arguments and are able to convince that this is in the interest of the system. And I agree absolutely that the system has to develop and prove, right? And all this is a kind of transition phase when the snags are ironed out. So take care. You have a bad cough. I hope you have something to drink. Yeah. Okay, Siddharth. Thank you, Siddharth.
Yes. Thank you, ma'am. Thank you, SHM, for this particular opportunity. This particular discussion that was going on was really, really fascinating because I'll come to the usual part of stance, rate, communication, all these things, but can't resist extending the discussion on liquidity and where a few relatively small, fine, nuanced developments, how exactly that's impacting liquidity. One example I'll pick up. From December onwards, the RBI has actually shifted the reporting framework from a reporting Friday, existing practice of reporting Friday, to the last day of the month. Now, why this is so important from a liquidity point of view? That had it been the earlier framework of reporting Friday, the reporting would have been done on the basis of 26th December. Now the reporting is being done on the basis of 31st December. Now, the moment it's the last day of the quarter, you actually see a jump on deposit numbers, credit numbers, etc. Loans gets disbursed, they get parked in the current account, and also the interest application comes into play. So whatever would have been my deposit balance on 26 December compared to that, my deposit balance, reported deposit balance is significantly higher, materially higher in those 5 days. The implication of which the banking system will be seeing in the subsequent 2 fortnights when they have to park a little higher amount because their NDTL is going higher, you have to actually shell out a little higher quantum of money to be parked with RBI to go to the as your CRR balance. Now, just this particular small technical change is actually creating a bit of excess demand for cash on the parts of banks' liquidity management in the second fortnight of January. That's why it's not surprising that we started seeing short-end rates like CD rates, etc., climbing higher in the month of January in a very unprecedented fashion in this particular year, and possibly now they have started easing a little more as soon as February has started. The important thing here is this particular phenomena will be even stronger at the end of March, the impact of which we'll get to see in the month of April and towards the end of April. That's why it makes great sense on the part of RBI to do a lot more nuanced liquidity management. I'm glad to see that they are doing it. That makes perfect sense for the 90-day VRR that they have started doing towards the end of January, which will take care of the April demand as well. So I think the need for this kind of liquidity management has become a lot more, lot more critical. I'm glad to see that the feedback mechanism is working well, and RBI had been very, very prompt in doing some adjustments. Now, there was a lot of curiosity why the RBI on 23rd of January is announcing one particular WAMO schedule, and in the next working day on 27th of January, they are actually changing that particular WAMO schedule to prepone some of the liquidity infusion and to ensure that that liquidity infusion is happening in the month of January itself rather than waiting for February. I think this is a great sign, but most probably we have to see a lot more of that going ahead, and we'll possibly have to adjust as bankers and banks, treasury would have to adjust for a bit of extra fluctuation of liquidity till we understand this particular code completely. And that's why at this juncture, to be open to feedback, to keep on providing liquidity in a much more nuanced and much more proactive fashion is extremely important. And I sense that will continue in this particular quarter or maybe a few more quarters, a few more months. So I think that has to be a cornerstone of the overall monetary policy framework at this moment. Had it been a few weeks back, I would have possibly come in this particular forum and said that, well, while I know that the market consensus is firmly in favor of a status quo here, I would have possibly been a little more biased towards the merit of easing even here. I would be hesitant at this moment because the volatility has increased in every possible market in the last 15, 20 days in an unprecedented manner. Because of that, I will possibly not be advocating a rate cut at this particular moment. Having said that, I would like to highlight this particular, there's not much of a debate that the stance can actually be neutral. And the role of communication is enormous at this particular point in time. It's very important on the central bank to communicate in that the rate cut cycle is not necessarily over. There might be a more opportune moment when the dust settles. I hope and pray that it settles faster than what we think. But there might be moments because as market participants, we need those carrots somewhere to look forward to. At some point of time, if I come and say that, okay, my rate cuts are over, that might not necessarily work in the best interest of the market. So overall, that's why I tend to say the neutral stance. At this moment, a pause on the rate pedal but extremely important is communication, particularly focusing around the liquidity aspect. The last point I would like to highlight that there are a couple of small concerns in the minds of the Treasury participants. If I talk now, that despite the relatively weaker flow of revenue, etc., the government remains very, very committed in terms of maintaining fiscal deficit target, which is great on one hand. Having said that, if there is some disappointment on the revenue flow over the course of the next 2 months, given that from February to March, the government will possibly not like to miss the fiscal deficit commitment of 4.4%, there might be a little bit of adjustment in the expenditure schedule is the expectation. Might involve a bit of flows from SDL flows also. So those things somewhere needs to be taken care of proactively as well. And absolutely the last point, spending less than 30 seconds, I would like to say, another issue remains that while repo rate has come down by 125 basis points over the course of the last about 12 months, there has been absolutely no change in the small saving rates. These two segments in a small way compete with each other. Somewhere this particular segment, it's not under the direct purview of RBI, I understand, but somewhere this particular aspect will also have to be relooked at some point of time. I'll stop here. Thank you.
Thank you. Very interesting points. This issue of the change in reporting Friday, in some way it must be releasing liquidity for banks through the month, no? Because every week having to meet now they have to do it once a month, although it does create a problem at the month end, compared to Friday. So, I mean, the idea of this change must have been to improve the system, because this governor and the whole regime is geared towards regulatory simplification and ease of doing business and so on. So all this must have happened after discussion with market participants. But it's true that any change involves some costs and adjustments. So on the whole, you think this change from the week to the month is beneficial? But
I clearly tend to believe so, because this will actually, because in certain cases, I'll just give one example. In this particular year, the earlier reporting Friday system could have led to a last day of the month at 26th. It could have been 19th of December also. And in the past, it has happened like that. And in the next year, if the last reporting day is 30th or 31st, then structurally we used to see a big jump in that particular year's number and a big drop in last, adding to a lot of confusion. Instead of that, if we get to see a middle of the month and end of the month, I think it eventually, as and when we all get accustomed to this, it is possibly a much better system. I completely agree with that. But this is the new adjustment phase. And that's why some of the teething issues we have to deal with.
Right. Yeah. But so as long as the confidence is there that they're listening and they're adjusting, do you see a good, your bank also, your back end, see a good response to suggestions?
Well, I think from a bank's point of most banks' point of view, I tend to agree with what Upasana mentioned, that bankers are possibly on an edge. Bankers do have to so I also echo her in terms of protesting against the word lazy banking. And I think there is a lot of interest. We get to see that in the high CD ratio that we are seeing at this moment. So overall, there is a lot of interest in terms of getting associated with the productive flows to the economy.
No, I see banks as being very proactive. It's interesting, good to see the way they have maintained profit margins despite, maintain profits despite margins contracting somewhat, and acting on many other sort of margins of adjustments, the operating costs and whatever the CRR, and you sort of borrowing more from markets if necessary, etc. So banks, it's not possible to be lazy anymore. A lot of different things you have to do. And markets are watching your profits. So many analysts analyzing what you do. So I think the system is maturing and moving in the right direction.
Not the slightest doubt about that. Yeah.
Yeah. So thank you very much. Now, next is Arjun and markets. Arjun, you're there?
Yes, ma'am. Okay. Thanks a lot. Thanks a lot, ma'am. Thanks a lot, Mr. Singh, for having me here. Couple of things. So I'll just briefly touch upon the budget and then after the budget on the RBI. So the budget was broadly on expected lines, though both equity and debt markets, they were fairly disappointed on the budget day for their own reasons. Now, the biggest positive is that the aggressive consolidation on the fiscal front is now well behind us. And so the drag on growth is also behind us from a fiscal consolidation point of view. And I think this is quite significant and that is being very underappreciated is that the last 5 years, ending FY26, we've seen roughly around 480 basis points of fiscal consolidation within 5 years. The last cycle of consolidation post GFC, we saw roughly around 340, 350 or so over a 9-year period. At that point in time, nominal GDP growth was fairly positive. This time, the last 5 years, nominal GDP growth has actually been on a trend lower, so which actually makes this even more significant that we've seen this consolidation. So I think it's a big positive from a government point of view that they stuck to their guns. Second, on the budget consolidation, on the numbers per se, I think the commitment to fiscal consolidation is very clear and very appreciated. Clear focus on lowering India's cost of equity as we sort of see it. On the forecasts, everything's credible, conservative numbers with some upside possibilities on the receipts front, especially if nominal GDP growth numbers positively surprise us. Now, on the capex, flat at 3.1% of GDP at the cost of continued revenue expenditure consolidation, and that I think is a signal positive as well. Now, it seems a bit likely that with the changes that you are going to see on the new GDP numbers, on the new CPI series, with lower food inflation weights and the double deflation that they're talking about in the new GDP series, we'll need to see if this same double deflation, it might cause higher deflator growth and some trimming of the real GDP growth numbers as well. So nevertheless, on the nominal GDP growth numbers, I think there's a likely possibility that you could see a slightly higher pace than they have assumed in the 10% in the budget. Now, one more bit on the budget that isn't appreciated enough is that this switch to debt to GDP, it largely means that the fiscal deficit will remain flattish with a very small pace of consolidation touching roughly around, let's say, 4% by FY31. This would mean that any nominal GDP growth that you would see higher than this 10 or 10.5% over the next 4-5 years would mean that you will see much in absolute terms the spends on capex, even if they keep it at 3.1 for the next 5 years. The absolute spends will actually be much higher if nominal growth actually starts seeing a pickup. So I think that's a positive. Now that's the happy part, focused on the budget. Now on the RBI. Now I think it's a fairly close call, 25 basis points rate cut. While a cut might or might not happen, my broken record since June of last year has been that, see, the market yields, they are bottomed out well ahead around June of 2025. And rate cuts, I don't think, can sort of help soften this yield trajectory. And so, like Ms. Bharadwaj was mentioning, I don't see the need for RBI to cut rates at this point in time. I think from a yields point of view, there are three variables I think that are very important for yields, at least market yields, apart from rate cuts, etc., which are already priced in by markets. Markets sort of price in nearly a year in advance. Domestic liquidity, crude prices, and your rupee. So I think yields have started 2026 by retagging their relationship with crude fairly closely after moving very closely alongside the rupee in 2025. So in short, I feel 2026 would see pressure from yields from two key variables: higher crude prices if it does play out, and any pressures on the currency front. Now, that's my second broken record. My second concern is on the capital account, where FIIs are not seeing flows yet. FDI flows from 35 billion are roughly around under 1 billion in FY25, and there isn't much of positive flows in FDI as yet, which means operational pressure on the rupee, I think, will still remain. However, having said that, I'll end on a positive note. The Indian equity market underperformance, if you compare it with the United States, it saw a very sharp two phases of underperformance. The first underperformance starts just around the time the US president gets elected. And the second phase of underperformance starts, a steep one, when tariff imposition happens. Now, with this US-India trade deal announcement, I think let's be a little bit optimistic that maybe there would be some sort of a reversion of this underperformance that you've seen, and maybe some flows will start sort of coming in, stabilizing the rupee. We've actually seen a bit of that today. We'll have to actually see how the trade deal pans out. We'll have to see how this in flesh and bones, how the trade deal actually is in numbers. Once the markets see that, and if they are directionally positive, I think the confidence and the stability from a currency point of view also can sort of come back in. I'll stop there.
Yeah. Thank you. Thank you. So, I'm not muted. So, Sajid, yes, Arjun, we notice and I agree with you that this issue of, I think one thing that is under noticed is that now the fiscal deficit is almost equal as ratio to GDP is almost equal to the ratio of capex, and this is what is known as a golden rule in fiscal theory, because it means that you're only borrowing for productive purposes. And also the projects chosen are better chosen. So they are in infrastructure where there are externalities, it raises GDP and so on.
And the negative fiscal impulse is almost now zero. The drag on
and that was countered. I've been saying all through because markets really focus on a negative fiscal impulse. I think Abhik or Siddharth was worrying about this, that the government will tighten more to maintain it. I think that's countered by the better composition of expenditure. Last year we were expecting much higher capex. They had promised much higher public capex after the election cycle got over. They were not able to deliver as much as they promised. But what they did was very cleverly was give those GST rate cuts, so they passed the stimulus to consumption. So again, it was the composition of expenditure, the balance between a consumption cut and some public investment. And we saw the way GDP responded. So, the composition of expenditure, compensates for the fiscal consolidation. And as you're saying, now they have done most of it, and the further reduction in FT will be very flat. But because of this borrowing only for capex and that increasing growth, we'll see debt ratios coming down as required. So it's all very positive, I think. And maybe we will see debt flows also now with Warsh, the new governor. He's actually supposed to be a hawk, but he's promised Trump cuts. So what is he going to do? I think this gold crash is partly because markets are now fearing not so many rate cuts.
Warsh was actually a surprise, because I thought there will be somebody who is outside what we're hearing in the news flows. I thought it would probably be Miran, because he's the guy who's actually been giving out all these gold revaluation and all of those commentaries. I thought that would probably be one, but it seems to be a surprise that it's actually Warsh.
Yeah, but on the whole, what are the implications for India if Warsh rather than Miran?
Warsh, I'm a little surprised if it is really Warsh. Either he's completely turned around, or maybe from a Trump point of view, maybe Trump sort of realizes that the credibility of the central bank is much more important than he thought before. Because unless that comes back on alongside some sort of fiscal consolidation on the government side, there's no way yields will come down. And if yields don't come down, they'll still be paying through their nose, just from a yield point of view. So I feel there is a likely possibility, maybe he also understands that, hey, maybe we'll need to sort of switch. We can't really be beating down the central bank the way we have been all along.
Right. I think that's Trump has turned out to be surprisingly good for the world on the whole. Yeah. So thank you. Very interesting. Now, Sujit Kumar, is there? Sujit Kumar? Yeah.
Yes. Very good evening, ma'am, and
Good
good
evening.
evening to all. In fact, it's a real joy to listen everyone, and thereafter having the opportunity to. So I will be rather brief because much of the things are well covered. Just a couple of points around actually lenders' way response to the rate cut, because the data that we have till November, it shows that while on deposit side, the repricing has actually played out. Of 125 bips cut has more or less translated into 100 bips of reduction of the deposit rates. On the lending side, that has not played out that well. In fact, the biggest constituents, public sector, they have been the I would say most laggard in terms of passing on the rate benefits. So lenders have been anchoring their lending rates more to the what is the alternative available to the corporate. Now,
G6.
so long as corporates, specifically the corporates who have access to bond market, they could negotiate a better deal because otherwise they would have gone to raise bond, right? So when the bond market responded differently after June, these corporates lost their leeway with banks also. So banks played out opportunistically, and instead of passing on the rate cut, they have built the fear was that they will be losing margins. Instead, the profitability numbers are telling an otherwise story. Now this is where I would say the plumbing has to happen. It's not just a game of having sufficient liquidity, but it's about the game of having the incentive to act on it. I would suggest for this at least policy, there is no urgency on the RBI part to lower repo rate per se, but the language, sometimes persuasion works, sometimes hard, arm twisting also works. So that could be one of the ways to get it done. That has to go very, I would say, very stern way. The message has to go very stern way. That rate reduction is not to build your treasury. So that is something that we would like to see there. So I mean, stance-wise, likely to be neutral because they are having delivered a 25 bips cut in a neutral stance. I mean, it conveys the message that flexibility is there to act.
Right.
Yeah. On the external sector part, in fact, I would say the bigger macro story for us today is having a single-digit nominal GDP growth. Now we are not used to it, right? Whatever planning we do as a business person or as a lending community, we have always factored in more or less 12, close to 11, 12% of revenue growth. Now, for last couple of years, we are seeing revenue growth in single digit. Now, this is something that worries me, because when we plan for the capacity expansion, all these things are linked to our revenue generations. Having a pristine balance sheet and still not willing to bet on future, that says that confidence is not there. Thankfully, the GST story is kicking. So after GST rationalization, at least some part of I would say demand is now visible. The consumption spending is back on the table. That should give us some comfort. The export side, thankfully, in the last couple of days, the good news has started flowing in. So if that plays out also better, so the external side of demand also come back on the scene. Now, on the government side, since capex outlays have been, I would say, even in fact allocated better than what market was anticipating, but within that capex, if we look at the mix, like it goes towards let's say high-speed freight corridor or railways. This is where actually government spends, and the scope for private play is limited. The objective of government spending is to have more space for private sector to participate and then contribute. So the capex story in a way is skewed if we continue to have it government heavy spending. That is one area where I am little, I would say, little surprised, because road sector last 5 years, if you look at the way road sector spending has continuously gone up and away, at least the private sector would participate in the half of that. In railways, the participation is less than 10%. The third one is the urban part. Now, in urban infra, while the messaging is that the government is open to making city administration more accountable and giving them more freedom in terms of conceptualizing projects and arranging funding, even having one-off incentive of 100 crore for raising 1,000 crore of municipal bond. So this is something where a lot of, I would say, coordination is required from center, states, and other intermediaries. So the bond market piece is where I would say some intervention is required, because it's really not mirroring what is overall policy objective of country, whether it is a fiscal policy or the monetary policy, and then giving the very hard message to lenders that their part of responsibility has not been fulfilled. So this is where I think I would stop myself, and that's where I place my hope also, this policy corrects that.
Yeah, really excellent points. This issue of low pass-through by banks to lenders because bond market rates are staying high. So this you talked about two things. One is arm twisting. Second, improving the plumbing. So arm twisting, you're saying hard message, but what about improving the plumbing? What are you seeing there? What can be done there to increase the city administration or because I was at a meeting with the CAG and their report really flags the kind of ways in which expenditure is misused, at state government levels and, accounting weaknesses, etc. So one point that came out was that many, you don't even have accounts in the cities. And that's a precondition for municipal bonds, to have good account. So this kind of and so what is the plumbing improvements you see that are feasible, maybe that the RBI can implement in this current policies?
See, on the municipal side, in fact, 25-26 has been relatively much better compared to early years. We have more than 1,000 issuances, and I think 4-5 issuances have come from cities which we would not have thought 2 years back, right? From Eastern UP and other parts of UP. Now, this is something really positive happening in that space. But the point is that unless larger cities participate in municipal bond issuances, the appetite for having large-scale projects will not be there with the smaller cities, right? And that is where the absorption is required. When we talk of market-based financing, it is not just having an optics for it, but kind of shifting the burden from one part of government to the other part of government, right? And where in fact spending priorities could be much better. So in my understanding, spending priorities are better delivered when it is at the level of local level governments rather than center having it all the way. So from RBI side, I think that plumbing part is anyway there. Because if you recall, ma'am, 10 years back, Mahua had come with this study, and they kind of made all municipalities, close to 200 municipalities, go and have a rating. But a quarter of them actually have dropped that rating. So they have not exercised having come that far, having their balance sheet audited in time and then being eligible for a rating. So these are the pieces where this coordination is much more required. At least have accounts in time, maintain proper records with banks and all. This is where, I mean, as a DFI, NAFID itself is playing that role. We are having both capacity building initiatives as well as, we are, in fact, I will tell you, of the issuances of this year, more than 50% is actually subscribed by us. So NAFID has also been there as an investor. It's not just about that we are helping them raise money via bond, but as an investor also we are participating in that. So we're playing on the both side of it, and we are in touch with close to 200 municipalities to get it forward. How far we will succeed, time will tell. But that awareness is all is actually going down there. And Finance Commission report, in fact, thankfully, they have understood this. So additional carve out that is being given to states and for downstream government, that's welcome positive in this regard.
But are you confident that the accounting has improved adequately for municipalities, that they will be able to use this money well? It won't all sort of go in corruption and waste.
So accounting is actually, in fact, whatever money is being raised, since there is a escrow mechanism where it's tied to projects. So that way, I mean, there is an assurance at least for the lenders and investors that money is being there and will be put to use. It's being audited in time. So the concern for us is actually having every year proper audited accounts on which ratings can be in a way maintained, which doesn't happen for most of the municipalities. That is where I think whatever agency we talk of, whether it's NITI or even us, they have to keep persisting about it with the state governments in the UL base. That is where a lot of initiative and efforts required.
Right. Yeah. So these plumbing issues are very, very important to spend money effectively, raise money. And your point about more government spending, this is what they say, the finance ministry, that the spending is better designed, more financial instruments, so that it is leveraged by private spending. More private participation in all this can really leverage the amount that the government provides. So they feel it is happening, but you are saying that it is not there so much. It
No,
is more in the growth sector.
Yeah. So I will give you an example. In last 1 year, kind of projects that have come on the road sector, the new allocations that happens, or even the renewable space, right? Even the awarded were cancelled out, right? So much of gigawatt capacity got cancelled out. The bids were cancelled out. So this is something that we have to be really serious about. I mean, if you want private sector to be in and play for the long run, then first of all we have to open a space for them to participate. Now, railways is one segment where it has been a routine story for only government, and enhancing allocation for railways, while it is much required. In fact, I have been big votary for having more capex in railway part. That story is not fully leveraged yet, but that railway piece should also we should have a space for private sector to contribute. There is not much to do for private sector. Only the rolling stock piece is where private sector is a part. So these are a few things which I think it's ongoing. I won't say that it's not being considered, but sooner the better.
Yeah, right. It takes time to set in new systems, but I think the movement is in the right direction. So this economic survey also points a plan for cities, better coordination, right? I was saying that because, I've done some research in this, that many of the local institutions, there are so many layers of institutions, constitutional, municipal, third tier, state, then center, and there's very poor coordination and overlapping responsibilities and log jams. So we should use technology to improve coordination, have someone with overriding power, all that. So governance improvements have to take place.
Truly.
So very interesting. Thank you. I think we are, we're through with all the speakers. Is that lady there now? Swati?
Raman Agarwal has joined us specially at my request.
Okay.
He represents the NBFCs. To have his reaction.
So Ramanji, we will look forward to hearing your side of the NBFC experience.
Thank you, ma'am. Good evening, and thank you, Charan Singh sir, for this opportunity. I'll be short and crisp. I'll just start with what the finance minister said in her budget speech about NBFCs. She said the vision for NBFCs for Viksit Bharat has been outlined with clear targets for credit disbursement and technology adoption. Now, let me also tell you where this comes from. So 9th July last 2025, Finance Ministry hosted a full-day symposium on NBFCs in New Delhi, where the Honorable Finance Minister spelled out this target. And what she said was that as on 31st March 25, NBFCs credit stood at 25% of the bank rate. And she said that by 2047, this should double up to 50% of bank credit. So this is what the target the finance minister has given to the NBFC sectors. And I think by reaffirming it in her budget speech, this takes a very serious tone and connotation. And we at the NBFC sector, and especially FIDC, now that we are an SRO, we are viewing it in a very, very, with utmost seriousness. So just I'm taking cue from this and pointing out to some of the 2-3 nagging issues which we have been highlighting. Foremost, of course, since everybody here has been talking about liquidity for banks, liquidity for NBFCs has been an issue which has been creeping up time and again. We've seen on various instances. And if we see the recent trends, and of course, there has been a great talk, RBI has voiced about the concern about heavy reliance on bank funding. Now, that is something we at FIDC ourselves have been saying that this perhaps needs to be corrected. And one recent phenomena we see, a lot of large, the upper layer NBFCs and some of the higher mid-layer NBFCs, there has been a sudden surge in foreign borrowings. The ECBs have really shot up in that zeal to diversify. Now, I think as an economy, I don't think, although I'm not an economist, but I think whatever sense tells me that it may not be a very welcome or an acceptable move that you borrow overseas to lend retail in the Indian market. So I think it is better to have liquidity provided here. And moreover, a large number of mid-size, small-size NBFCs who cannot access capital markets and who cannot access foreign borrowings are totally dependent on banks. So I think this whole issue where we've been highlighting the need for a refinance mechanism for NBFCs is where I would like to once again reiterate, because it becomes much more relevant now that if we have to achieve that 50% of bank credit, and now that we are talking about the liquidity situation being tight for banks. So for NBFCs, I think there is certainly a case for a refinance mechanism. That's the first point. Second, two quick point issues which we've highlighted. Recently, RBI issued a circular, proposing significant changes in the risk weights applicable to various categories of loans given by banks. So, for example, there is a proposal to reduce the risk weight on housing loans from existing range of 35 to 50% to 20 to 40% based on the LTVs. And there are specific risk weights ranging from 30 to 60% prescribed for loans given to individuals for the third residential unit. Then they are proposing reduction in risk weights on loan against residential properties to anywhere between 20 to 75%. Further, there is a proposal to lower risk weight on lending to MSMEs from the current level of 100 to 85%. So this is being proposed for banks. For NBFCs, and in fact, this is something we've been saying, when it comes to housing loans, the current range is 35 to 75%, with higher risk weights up to 75 to 100%. And then loan against property attracts a risk weight of 100% and even 125%. And all lending to MSMEs, irrespective of the categories, is a uniform risk weight of 100. So I think there is a strong case here to bring in parity now that RBI has been talking of and has undertaken this exercise of harmonization of the regulatory framework. So I think this harmonization on the risk weight front is something that needs to be corrected. That's number two. And finally, I'll point out another very nagging issue, which we find it to very surprising. There is a central repository of information on large credits, the CRILIC, where both banks and NBFCs are supposed to report the SMA data on all large exposures of 5 crores and above. Incidentally, while NBFCs are mandatorily required to report data, but very strangely, NBFCs do not have access to that data. Now, this is something we've been pointing out for some time, but for reasons best known, I don't know, that has not been given. So I think this needs to be corrected. So I thought I'll raise these three quick points. Thank you, sir, for this opportunity.
Yeah, excellent points, sir. But this governor is said to be very pro increasing borrowing from NBFC. So have you raised these issues there at the RBI?
Yes, ma'am. We have. Yes.
So, for example, this access to CRILIC data, there should not be. What is the barrier to doing that?
Frankly speaking, we haven't, ma'am, received any justifiable reason for that as of now. But as you said, we will continue to certainly take this again.
And refinancing, they were, your NABARD or something, some organization. Is there any progress?
No, not, ma'am. Actually, we've been suggesting maybe SIDBI or NABARD could be the ones, because they are already lending to NBFCs. So there has to be some direct. So currently, while they do it out of their own balance sheet, which is a very limited corpus. So I think unless there is a specific fund allocation done to them with a specific mandate to refinance to NBFCs is something which is the need. And I think that is yet to be done.
So there should not be any problem in doing that. Maybe the budget has no provision for that?
No. In fact, that is what we presented to the finance ministry. Yeah, we raised it. In fact, I raised even in the pre-budget meeting also. I requested the finance minister, but I mean, till now it has not been done.
In fact, I was talking to some official in one of these institutions, and he was saying that the NPAs have really gone down in lending to NBFCs and so on, because of use of GST data, and so those risks come down, then risk weights should be reduced. And so are NBFCs using data in their loans so that
oh yes, ma'am. Oh yes.
Have your NPAs come down substantially?
Yes. Because if you see the overall contribution of credit to MSMEs, NBFCs growth is much higher than that of banks. So the NBFCs are share is going up. And in fact, as you rightly pointed out, now it's the GST data which is becoming very very popularly being used to get that's the most authentic way to get updated cash flow picture and do any kind of security free lending over and above the credit guarantee coverage which it is provided.
So, if you flag this, I think they're doing it in AppFid and so on, pointing out that infrastructure risk is going down because of better use of data and, this cash flow data. If you flag that and show, that your NPAs are reducing because of this risk is reducing, then you have an argument to support the reduction in risk weights. And so,
Sure.
yeah, good.
Yeah, sure.
Thank you. So is Swati here? She was not there earlier. Has she joined? No.
No, ma'am. She has another meeting actually. So that.
Okay. So is somebody giving a vote of thanks?
Charan sir,
Charan, I hand it
I would
to you.
request if you can go ahead with that.
So just to summarize, everybody seems to be with the neutral stance, with communication on easy liquidity and space for a further cut. But the majority expect or recommend a pause with one vote for a cut. Yeah, Charan?
Yeah, absolutely. Totally agree. That's what our stance is, very neutral, and we need to maintain liquidity. And then there is pause by everyone. There is space, but pause recommended by all except one. Totally agree. I want to thank you, Professor Ashima. I want to thank each one up here who made that very strong and very good, rigorous contribution. Raman Agarwal ji, I want to thank you. We invited you specially, and you made a very substantive point, all three of them. I would request that if you could give me a brief write-up, we could quickly publish it on our website and then push it wherever we can. With that, let me thank SOCHM once again to have provided the platform to help us discuss along with the industry the thoughts of an economist, practitioners on the monetary policy. Thank you very much for being here.
Yeah, thank you, Charan. And I think this platform is really, very intense and interesting discussions and points coming out. So my one question I had is that why don't we have more participants? Is this open to the public or not?
Professor, that is, if you say we will open it, but generally we wanted it a very tight and only by invite so that we maintain rigor and we do not make it we don't dilute it. So I was the one who requested them that it will not be open to everyone. Just want a very tight group and trying to mimic the monetary policy committee. So that was the purpose. And as a special
But
guest,
other discussions available after that, there is a very strong reason, not to have all sorts of, can become very political and then you cannot have frank discussions also. So, but I think some of the discussions could be useful, or you believe that they won't be so frank if this is not, the recording is not available publicly, right, after the event?
after consulting you today or tomorrow, I will go back to SHM and find out if we want to do it in public domain. The recordings, to my understanding, are not in public domain.
Right.
But
so I think we should ask the current members what is their view on this. Is it
Yeah.
better to have a closed, frank discussion, or do you think this should be made available more widely?
Sure,
After
we
the
can do
event, we can ask
the
them
event,
for
yeah.
their view.
I do know some of the speakers do write articles after the event is over. So that I know. But I think it's a good suggestion. I can speak to all the members and find out if they want it later released in public domain, like the minutes of the MPC are released. Why can't this be released? So I can.
No, but the minutes, in the sense, what we send you is available publicly, right? But the discussion is not available.
No, discussion.
So the question to ask is if they want the discussion to continue to be a closed group, which can lead to more frank and intense debate, or they suggest it could be made public after the event. Yeah.
I'll check with them because initially when we started,
because we were getting market participants and they did not want their voice in the market.
Yes. Actually, it
Because
is true. They can speak much more frankly if it's closed. And
so they did not want it in the market, their recording to be put in the market. And whatever filter that they wanted to put in the public domain, then they send me that paragraph. So that is what we have maintained all these years. But I can go
But this
back.
recording, do you make it available to, say, the RBI or to regulators? No? Okay.
If they haven't asked for it, I haven't sent it to them. That's my, but I'll come back to you.
And when you say it is a closed group and by invitation only, so are you in, I mean, you have a list of invitees that you invite?
Yes.
Apart from the members. So maybe
Yes.
you can ask the members if they suggest anyone who could be asked to join.
Sure, we can do that. Sure, we
Yeah?
can do. Yeah. I can ask the members if they want anybody to enter in by invite, we can. Otherwise, we just invite a limited number of people, keeping in mind the privacy or the secrecy of the discussion that's taking place.
Yeah, okay. So good. I think it was a very rich discussion, very interesting. I learned a lot.
Today was very good. Today was very good. Thank you.
Okay.
Thank you. Thank you.
Bye.
Thank you, Ashima ma'am. Thank you.
Bye. Bye.